Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, March 6th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is U.S. exceptionalism dead? Our answers are risk assets are increasingly feeling the strain amid increasing fears of stagflation in the U.S. economy. This dynamic is playing out across global markets with the S&P 500 and NASDAQ 100 down over 1% apiece. The semiconductor sector is facing further headwinds as Alibaba's latest model, QWQ32B, outperformed rival models while also materially undercutting them on training and inference costs. Elsewhere, the policy landscape in Europe is evolving rapidly. Incoming German Chancellor Friedrich Merz has vowed to amend the country's constitution to remove fiscal constraints on defense and security spending, a significant shift in EU fiscal policy and German fiscal policy. His proposal includes a sweeping 500 billion euro infrastructure investment plan spread over the next decade. The EU is broadly gearing up for an aggressive financing push, unveiling a euro 500 billion loan program, alongside an additional 650 billion national budget mechanism designed to bolster defensive capabilities without formally breaching budget rules. Investors are swiftly repricing European financial fiscal policy risks, leading to a sharp sell-off in European sovereign debt. Countering the hawkish repricing of European and global bond markets was the 25 basis point rate cut by the ECB today, their sixth reduction since June, which lowers their deposit rate to 2.5%. The ECB statement described its monetary policy stance as meaningfully less restrictive, a signal that they may slow the pace of rate reductions in subsequent meetings. The euro-US dollar cross is up nearly 4% on the week. Volatility is likely to persist as investors assess the ECB's ability to maintain its current easing bias amid expansionary fiscal policy in response to rising geopolitical tensions and shifting policy priorities. A declining US dollar is typically a good thing for global liquidity, but it may not be in the context of 10 plus trillion in global capital flows that have flowed into US assets over the past half decade. A further unwind of crowded positioning associated with the US exceptionalism theme is a market risk in and of itself. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one is regarding carry unwinds. It says, hello, Skipper. In response to today's leadoff morning notes summary, says, who else besides Japan actually had low enough interest rates in the last 2 years or so to allow them to execute the carry trade? How much of the carry unwind via JPY, via dollar yen has already occurred? There have been several instances already since August 5th. So excellent question. So the reality is the whole world, at least on the G10 front, could have financed U.S. dollar carry trades because the U.S. has been, generally speaking, across G10, the largest yielding, the highest yielding currency. And obviously we've had extremely buoyant capital markets given our exposure to the global AI theme, at least over the last couple of years. And so, and by the way, when you're talking about carry trades, it doesn't necessarily mean Japanese investors carry trading into U.S. assets. It means any investor globally is funding themselves. If hedge fund leverage, any sort of levered investor is funding themselves globally with Japanese yen because it's cheaper to fund in those currencies. So they could be domiciled in the Caymans, they can be domiciled anywhere. So just be aware of that. So obviously Swiss francs yields have been very low. Chinese yields have been very low, but they have capital controls, so you wouldn't be able to do that with them. But broadly speaking, the carry risk in recent years has come from the Japanese yen and the Swiss franc. And getting back to the second part of the question, how much of the carry unwind has already occurred? So no one knows. I mean, these sell side banks put out these reports like, oh, X% of the carry has been unwound and this and that. And the reality is they don't know. Nobody knows what everyone else's positions are in global financial markets. So you always have to take those estimates with a grain of salt. Now, those estimates are going to be better than everyone else's because those banks have hedge fund clients using their prime brokerage services. And so they can kind of amass and assess what they see out there and maybe look at each other's, prime brokerage reports, whatnot. But the reality is we never have a holistic view of market positioning. We're always using incomplete data to kind of paint, piece together a puzzle. And so getting back to the yen carry unwind, how much of this has been unwound already, and I'm just using this as a proxy. If you look at net non-commercial net length across futures and options in Japanese yen positions that the CME keeps track of, or CFTC keeps track of, we've completely unwound the yen short. We peaked in early July in terms of the yen short, and now it's a massive yen long. In fact, it's a 10-week high. Let's see how far back we got to go to get a high, to see a higher level. Yeah, no, I mean this might be an all-time high in terms of the net long bias in the yen. So maybe the entire yen carry position has been completely unwound. In fact, yeah, this is an all-time high in speculative net length in favor of the Japanese yen, the current most recent data. So based on this obviously incredibly incomplete mental model, you can make the case that we've seen the full unwind of this trade because the same dynamics that would have caused investors to unwind their yen short in the currency market are likely a lot of the same dynamics that would have caused investors to unwind, a lot of those assets, in the broader capital markets like corporate credit, private credit, equities, et cetera. However, and this is a big however, the U.S.'s net international investment position has more than doubled over the past, or has doubled over the past 5 years. And in fact, we've added $12 trillion. International investors have added $12 trillion of net length in U.S. assets over the past half decade. That all didn't get unwound in the last 6 months. Obviously, we hit a new all-time high in S&P terms in February. We obviously hit all tights, cycle tights and credit spreads year to date as well. This is, in our opinion, even if the unlevered part of the yen carry trade unwind is completely gone, if the levered part of the carry trade unwind is done already, the unlevered part of the unwind may not be. Right. You got about, think about international investment managers on the asset management front, insurance funds, pension funds, sovereign wealth funds. Globally, the U.S. has been by far the best place to be in both the bond market and in the stock market over the past couple of years in terms of carry and in terms of the returns that we've seen in our equity market. And if the U.S. exceptionalism story is dead, a meaningful chunk of this flow, these inflows could actually reverse. We could book gains, realize the gains, and start to invest in European defense stocks, or start to invest in, the Japanese yen, or start to invest elsewhere internationally. This is not an overnight process, but it is a material risk in terms of the legacy positioning associated with the changing, U.S. fiscal policy dynamics and how those are impacting the U.S. economy from a growth perspective. So I just want to make sure investors are aware that there's a levered part of the trade, but there's also an unlevered part of the trade. And the unlevered part of the trade is as big as any inflows on a trailing 5-year basis into the U.S. economy that we've ever seen. So wrapping it up there, Darius Dell here presenting our macro minute for Thursday, March 6th, 2025. Everyone have a wonderful day. Best of luck out there. We'll catch back here tomorrow. And P.S. we have our monthly macro scouting report coming out for the month of March tomorrow afternoon. If you are confused, and if you're not confused, it means you're not paying enough attention. If you're confused about where we're headed from a growth perspective, or we might be headed from an inflation perspective, where we're headed from a fiscal policy perspective, where we're headed from a monetary policy perspective, and how all that's going to impact liquidity, corporate earnings, that's what we do in our macro scouting report. We answer all those types of questions. It's a high-end institutional product, but we make it available to retail investors at a very low price point because, again, we want to have a very positive impact in terms of changing the way retail investors approach financial markets for the better. So check that out. Check that out if you get a chance. Everyone have a wonderful day.